Good day. Thanks for joining another Leading Voices in Credit podcast. I'm Van Hesser, Chief Strategist at KBRA. I'm delighted to be joined today by Stuart Aronson, Executive Managing Director and CEO of WhiteHorse US. WhiteHorse Capital is the direct lending arm of H.I.G Capital, the global alternative investment firm with $62 billion under management. And by way of introduction, Stuart joined WhiteHorse in 2016 from GE Sponsor Finance, where he served as president and CEO. GE Sponsor Finance at the time was the leading market provider of debt financing to the U.S. sponsor middle market. Stuart, welcome to the podcast.
Thank you, Van.
Stuart, define for our listeners that might not be familiar with WhiteHorse Capital where you compete in private credit and what you think are some of the differentiating features of the firm.
Well, the parent organization that we're a part of, H.I.G, has been open and operating for 31 years now. And it was founded on the concept that it wanted to take advantage of the relative inefficiencies in the mid-market and lower mid-market, as opposed to competing in the more efficient spaces of the upper mid-market and large cap market. WhiteHorse and frankly GE before that subscribed to that same philosophy. That as you get into larger transactions that are intermediated by larger and more sophisticated firms, that the market becomes very efficient. And as everyone is aware, as it regards the private equity market, larger private equity firms employ capital markets partners, and the capital markets partners run auctions for the financings of their deals that often involve dozens and dozens of different players. So in order to win a financing in that more sophisticated, larger market, a firm typically has to be the most aggressive on terms, the most aggressive on documents, and the lowest on price. And that is compared to dozens and dozens of players competing. The mid-market and lower mid-market tend to be less efficient as the size of the players in the market gets smaller. So in the mid-market, where you might be dealing with a $75 million EBITDA company, the market is still pretty efficient. And frankly, you often still have those capital markets partners running sophisticated auctions for the financing. But when you get down to the mid-market and lower mid-market deals that are controlled by the smaller private equity firms or the non-sponsor lending market, that tends to be a less competitive, less efficient market where there are fewer players involved, normally 2, 3, or 4 as opposed to dozens. And there's typically not a capital markets partner making a decision purely on what is the most aggressive deal. There's a lot more relationship orientation in that mid-market and lower mid-market sector that allows for, in general, we believe, a better risk return. So at WhiteHorse, we are focused on the mid-market and lower mid-market. And when the market environment is broken, like it was in 2022 and 2023, we participate more in those larger deals because the relative risk return in those market environments is attractive. But when the market gets to be like 2021, or what we're seeing so far in 2024, we dig in to what we call the off-the-run sponsor market, the smaller private equity firms, and the non-sponsor market, trying to find better risk return than you will find in the general upper mid-market or large cap market.
Yeah, so let's pursue that a little bit, Stuart, if we can. So obviously, lots of attention out there of private credit firms moving up market, big deals that were typically done in public markets in the past. And we're seeing now that competition that you talk about, compromising term and price. How or what's your experience been in sort of that mid to lower mid market? Are terms and price holding up as you hoped it would?
There's no pure rule of thumb as to how aggressive a deal gets based on the size. There are some larger deals that are done on a more relationship-oriented basis that might not be as aggressive. And then there are some deals in the lower mid-market where one lender, for whatever reason, gets overly aggressive, and that deal can become too aggressive. But I'd tell you what we have seen fairly consistently, as again, not as a rule, but as a trend line, is that the off the run sponsors, the smaller private equity firms with fund sizes under a billion, all the way down to fund sizes of 100 million, put together transactions that are less aggressive on leverage, less aggressive on price, and less aggressive on credit documentation terms. In our lower mid market fund, which operated all the way back to 2018, so through some very aggressive market environments, our average leverage has only been about 4.5 times. Whereas, back in 2020 and 2021, people were regularly doing deals at 6, 7, and even 8 times leverage, or doing ARR deals where the leverage on an EBITDA basis was infinite. So we have definitely seen, focusing on the market environment sectors that we focus on, that we are able to generate deals on average that have an attractive risk return profile. In the sponsor market, lower mid market, 4.5 times leverage on average. And in our non sponsor lending market, closer to 3.5 times on average.
Yeah, that's an interesting point. So, Stuart, take me back a little bit to your past at commercial finances, 800-pound gorilla, GE Capital, right? So, it's always curious to me with all the attention that private credit gets. It's like this thing just sort of popped out after the leverage lending guidelines in 2013 and grew this business out of nowhere. Obviously, those who have been in this business for a long time know that, commercial finance has been done for a long time. But there are some important changes to how this market has developed. Compare, if you would, what the world was like back when you were financing at GE Sponsor Finance versus what you see today in the market. Are there material changes, and what are some of those changes that you see?
Yeah, back at GE, when we were competing in the mid market and lower mid market, frankly, it was, from a credit perspective, very similar to what you see today. Credit rules don't change. Cyclicality is cyclicality. Customer concentrations are risky. Product concentrations are risky. Supplier concentrations are risky. If you do a deal where you're reliant upon a regulatory body to approve a reimbursement rate, or even certain types of business to be allowed to be done versus not done, you're taking risk that an administration change or even just a person changing in a department can have a profound impact on the profitability of the company that you're lending to. So I would tell you that the lending guidelines that we follow at Whitehorse, the lending guidelines that we think the smart and responsible direct lenders in the market follow, are very similar or almost identical to what we followed back at GE in the day. The benefit of GE in the day was that it was a AA to AAA rated entity, and we could raise our money through our treasury department, and we did not have to do the tens of thousands or even hundreds of thousands of miles of traveling every year to go out and raise capital. I'd say the other thing that is a little different, that is now really being driven by the upper mid cap and large cap lenders who are raising money on a semi liquid basis, is that they are raising money where capital needs to be deployed very quickly. And that is creating an unnatural need to deploy capital regardless of the supply of opportunities in the marketplace. And that is leading to some players who we think are paying less attention to the old fashioned basic credit guidelines, because their need to deploy outstrips everything else that they're doing. And so if you talk to the upper mid cap and large cap players these days, there are a couple players in the marketplace who they point at who are arguably showing less discipline and doing things that, if we have a down cycle, could end up being very costly. Thankfully, we generally are not seeing that behavior in the middle market or lower mid market. That tends to be an upper mid cap and large cap dynamic right now, further enhanced by the fact that the upper mid cap and large cap direct lenders are doing battle with the Wall Street firms to prevent a shift of market share back to the Wall Street firms, where the direct lenders had taken that market share in 2022 and 2023.
Yeah, so let's a range of market observers, from the IMF to the legacy rating agencies that are out there will talk about a systemic risk potentially in this wave or this particular phase of private credit. It sounds like from your comments that there's a little bit of concern out there that there could be too much money chasing too few deals. How do you see all this playing out? If we're in kind of a softish landing scenario, is this something you worry about? Or is this something, again, it sounds like in your particular spot in the market, you feel pretty comfortable that risk and reward are still very much in alignment. But do you worry about somebody larger having a misstep here that's going to be problematic for how investors think broadly about private credit?
Broadly, the investors in private credit are diversifying their investing across a large number of players. And so I don't think there is a lot of systemic downside risk to the economy in general because of one, two, or three direct lenders who are overly aggressive and might end up either taking losses or not generating returns that are in line with what they promised the market. Senior secured lending at its core is a very good place to be in both up cycles and down cycles. And I was at GE running a senior secured lending book when the Great Recession hit. And I can tell you that the profitability of that pool of senior secured loans was remarkably stable. Now, again, that was middle market and lower mid market loans that generally had covenant protection. And with that covenant protection, you had private equity firms or owners of companies stepping in to protect their company from the issues that were arising during the Great Recession. That is a little bit less clear and a little bit less certain in what's going on in the upper mid cap and large cap market now, where you either have pure covenant light on the vast majority of large cap deals, or what we call covenant loose or quasi covenant light on a lot of the upper mid cap deals, where the covenants are set at levels such that there'll be a payment default before there's actually a covenant default. And that can happen either because the covenant is set at a number like 9 or 10 times, where with interest rates where they are, you can't get to 9 or 10 times usually without having a payment default. Or more commonly, the covenant will be set at a level that looks fairly reasonable, but the definition of EBITDA that drives that covenant will have so many add backs, in fact, sometimes unlimited add backs, that covenant has no teeth. And what we see is in terms of downside risk, the structure that has been put into the upper mid cap and large cap deals has never survived or had to go through a significant downturn. I mean, the last significant downturn we really had was the Great Recession. In the Great Recession, covenant light existed, but people may not remember the only deals that got covenant light back before the Great Recession were the best, strongest, most stable companies. Now we're in a world where cyclical companies and companies with customer concentrations and all sorts of other things are all getting covenant light. And then add into that the fact that the documents are now so weak that when you do have a payment default, the owners of the company are often able to strip collateral out of those companies or put in super senior debt ahead of the existing lenders. And I think that's generally referred to in the market as lender on lender violence. And those arising dynamics in that upper mid cap and large cap market mean no one really knows at this point when there is the real downturn, or a downturn, hopefully not as bad as the Great Recession, but something that looks like a more traditional downturn, what the loss given default on those deals is going to look like when you get done with the lender on lender violence, and the fact that you've got the equity pretty much wiped out before you have any type of covenant default, or if the case would be payment default.
Yeah. So again, going back to sort of your core market, comparing it back to what you wrote out the GFC with at GE, how would you compare, document strength, covenant protection in your book today?
The lower mid market really hasn't changed all that much. Lower mid market companies typically still have one or maybe two financial covenants. Those covenants are typically documented with definitions that work such that you have a covenant default while there's still somewhere between 20 to 40% equity value left in the deal. The middle market is a little more aggressive than the lower mid market. We define middle market to be above 30 million of EBITDA and lower mid market to be below 30 million of EBITDA. And certainly between 30 and 60 of EBITDA, you're typically getting at least one financial covenant and pretty reasonable definitions and protections. So what we see is that in general, the lower mid market is a 4 to 5 times leverage market with real covenant protection. The middle market is a 4.5 to 5.5 or maybe 6 times market with still pretty decent covenant protection. And we think most of the players in that market are consistent in the credit standards they apply and the requirement to have these protections on the deals. There's a little bit of noise going on right now with the battle going on between some of the larger players and the Wall Street firms, that some of the larger players are coming down market and bringing some of the larger market terms into the upper part of the middle market. And so as you and I'm sure many others are aware, above 50, 60 million of EBITDA in 2024, a lot of deals are getting done covenant light, where in 2023 and 2022, that just wasn't happening. So as people, again, who bring those larger structures are coming down into the mid-market, you have seen some degradation of terms in what I'd call the larger part of the middle market, above 50, 60 million of EBITDA.
So, Stuart, we published here at KBRA our first quarter middle market borrower compendium and reported that 21% of credits reviewed, it's a subset of all of the, I think, 3,500 or so credit assessments that we do. 21% of those credits reviewed saw their credit worthiness migrate lower. Probably not a surprise given the rate rise, given the competition in various sectors that's out there. What are you seeing in terms of how your book is performing, one, and then two, how do you view the future in terms of the growth opportunity? Is this the time to sort of pull back and batten down the hatches, or how are you approaching the future, given, some of the changes that we've seen?
So we were talking with a firm that does quarterly valuations on assets in the marketplace, and they shared with us a statistic that I believe the number was 36% of the total deals in the marketplace are not currently generating cash flows sufficient to get to a 1.0 fixed charge coverage. So I think if that statistic is true, and again, it was not generated by us, it was shared with us, that is a very interesting insight into portfolio of deals currently in the market vis-a-vis the very high base rates that we see in the market today. Add into that your specific question about what's the trend line going on in credits. We have definitely seen about 30% of the credits that we currently have in portfolio are performing on an EBITDA basis less well than they were at the closing of the deal. About 30% of the deals are performing similarly to what closing looked like, and about 40% of the deals are doing better. So there's a interesting split between how different deals across the portfolio are performing. But we have definitely seen that companies that face the consumer, and especially companies that face the consumer and sell through brick and mortar retail, have had a tough year to 2 years, as brick and mortar retailers and even online retailers have been destocking, and a lot of consumer demand that was very heavy during the COVID period has slacked off as consumers are spending their money in a different place than they were during the COVID downturn. In terms of what we think is likely to happen going forward, our portfolio, both on the debt side and our parent organization's portfolio on the private equity side, had indicated to us 6 to 12 months ago that inflation had not been tamed the way the Fed wanted it to be tamed. We weren't seeing price increases coming from our portfolio companies being as low as 2%. And so as the end of last year rolled around and the new year started, and people were talking about 6 rate cuts starting in March, we were raising our hand and saying we just don't see how that's going to be possible. We were advising our LPs that we thought the more likely scenario was 0 to 2 rate cuts, and those rate cuts occurring later in the year. And likewise, unless that higher rate environment was successful in slowing down the economy, we thought there were going to be fewer rate cuts into 2025 as well. So our general philosophy has been inflation is still out there. It's better than it was, but it's not down to what the Fed's targets are, and rates are going to remain higher, and that is going to put a damper on the economy into late 2024 and across into 2025. We're not predicting a recession per se, but there are a lot of people out there right now that think that there's going to be, I think it's referred to as no landing. So there's not going to be any particular downturn. And we do think that the economy is in general softening right now, and that it will continue to get softer into late 2024 and 2025. And all of the underwriting we're doing on new transactions assumes that type of weakness in the first 2 years of the deals that we're underwriting to.
So I'll take this opportunity to trumpet our own calls along the way. We have always been in the don't fight the Fed camp. Take them at their word, right? The incentive there, and in every Fed tightening cycle that we've seen, I think since the 1950s, the Fed typically overshoots, right? Their credibility is gained by taming inflation first and foremost. So I think we would agree with you there, and we do expect also a softening over the course of the year from, let's face it, it's above potential growth. So it's been a good environment. What does that mean in terms of your growth, given all the competitive dynamics, given your, a penchant for being conservative at this point in the cycle? What can you pencil in for growth over the next, 12 months or so?
Growth in the market or growth in the WhiteHorse portfolio?
The latter, so it's going to be a combination of you taking advantage of opportunities. It might be there, maybe competition pulls back, whatever it's going to be. I'm just curious, given what you're seeing or what you're looking at, is this still a constructive environment to originate credit?
So Van, we tell our investors that we are happy to grow, but we only grow if the risk return environment supports doing so. In 2021, I met with a number of LPs who were frankly upset because our deployment rates were so much lower than many of our competitors in 2021. And we shared with those LPs what we saw going on in 2021 in terms of incredibly high leverage multiples, enormous adjustments to EBITDA and add backs for synergies and such. And we shared with investors that if interest rates went up, and we were only modeling 300 basis points increase at the time, not 500 basis point increases, but many of the deals we were seeing in 2021 didn't work with a 300 basis point increase, much less 500. And so we didn't grow nearly as much in 2021 as many other players did. Now flip that to 2022, the market's broke. And from a lending perspective, you could do deals a full turn lower and 100 basis points higher in rate. And then, of course, base rates were rising as well. So senior debt in 2022 and into 2023 became very attractive. And we did higher deployment than many of our competitors. It's not necessarily that we're trying to be quote unquote counter cyclical. We're just looking at risk return in terms of old fashioned metrics like loan to value, leverage multiple, interest coverage ratios. And when the market is attractive for lenders, we've been doing this a long time and we know what attractive debt deals look like. So we are not focused number one on growth. We're focused number one on finding appropriate risk return. We are particularly advantaged in doing that because unlike a lot of players out there that try to operate very leanly and call on the larger private equity firms where there's high volume, which can be done very efficiently, we actually operate with 22 originators in 11 regional offices across the country. So as I mentioned in my earlier remarks, as a part of our firm, we try to hunt for deals where other people aren't hunting. And so even in a market environment like COVID, where the market, for many of our competitors dried up, 80 to 90% of their deal flow went away. we still had pretty decent deal flow even during the COVID period because of that local regional originations network that was hunting for deals not only in the on the run, the larger private equity market, but also in the local, what we call off the run private equity market and non sponsored market, where by having local regional players, we find deals that don't make it to the New York and Chicago market. So in general, 2024 so far is a much riskier market for lenders than 2023 or 2022 were. But by having the number of people we have in all those regional offices, our deal pipeline any given Monday is typically between 170 and 200 deals. And if any given deal gets overly aggressive, and in today's market they are, we just walk away from those deals and focus on our deep origination capability to find us opportunities that are in line with what we think normal mid-market and lower mid-market parameters are. And that would be, and I mentioned them earlier, in the lower mid-market, 4 to 5 times leverage, loan to value, 40 to 55%. In the mid-market, leverage more like 4.5 to 5.5, maybe up to 6 times, with loan to value, again, running typically 45 to 55%, maybe creeping up to 60%. And we've been able so far this year continue to deploy into transactions that have those, what we think are reasonable credit statistics, not as attractive as they were in 2022 and 2023, but still attractive relative to a 20-year time horizon.
Yeah, I got you. So I was surprised about a comment I heard the other day, I think maybe out at the Milken conference, of someone saying that one of the most significant risks in private credit today is the outlook for recoveries. Presumably, going back to your days at GE, rolling forward, the recovery outlook could be weaker. Is that the right way to sort of characterize it? How do you think about recoveries? Is it a significant risk in this particular cycle, given how the portfolio has sort of come together, the concentration of hard assets, et cetera? What's your outlook, you think, for recoveries?
I think in the lower mid-market and mid-market, what is going on is very similar to what was happening 5, 10, 15, and 20 years ago. Leverage multiples, loan to value, documents, covenants are similar to what they were going back to an extended period. So I don't think recoveries will be particularly different in the lower mid-market and mid-market than they have been going back to the Great Recession, as an example. I think the upper mid-cap and large cap market have changed radically, as I shared earlier. The complete takeover of Covenant Light in the broadly syndicated market means that no equity is coming to the table until there's a payment default. And by the time there's a payment default, a lot of times the equity value of the company has been totally eviscerated anyway. The other thing that is going to have a significant impact on recoveries, and it already started over the past year and a half, is the lender on lender violence. It is the concept that lenders in those broadly syndicated or large cap deals think they have security in the assets of the company, but they only find out when that company is having problems that the baskets and the rules around those documents allow new lenders to come in ahead of the senior lenders, subordinate the senior lenders, and dollar for dollar dilute their recoveries from what they would have been. That was not true in any significant degree during the Great Recession. And I think loss given default in the broadly syndicated market and upper mid-cap market are likely to be dramatically different than they were in the last downturn. And the other dynamic that's out there, and the rating agencies have written articles about some of this, is how much adjustments, synergies, and add backs are being put into those deals. So people think they're doing a 6 times deal, but in many cases, those 6 times deals are really 8 times deals. And that is also going to lead to lower recoveries when people find themselves in credits that are underperforming.
Yeah, it sounds like it. All a function of having a lot of cash to put to work, right? I think we've seen this movie before. One last question from me, Stuart. Rumblings out of policymakers, right, of possible regulation, private credit. Are there particular areas you think the business would benefit from having some regulation? I'm going to assume that all regulation is bad if you're an operator, but maybe not. Are there things that you'd like to see to kind of corral maybe the excesses that are out there, which ultimately could come back to bite all market participants? What do you think about this issue of regulation?
I think as it regards the credit process as to where to lend and not to lend, it's not a place to bring in the regulators unless it's a bank and the bank is trying to protect customer deposits, which are then guaranteed by the government. So the government has a real stake in making sure that these banks do the right thing. The one place in the private markets where I think regulation actually could make sense is in the mark to market valuations that people show. We try to be very realistic about our mark to market valuations. But over the last couple of years, as we've looked at some of our competitors that have ultimately gone out of business, we have seen portfolios where marks on assets were absolutely indefensible. I remember looking at one company at a firm that was being sold, going out of business, where the firm had made a loan to a borrower that got its reimbursement in the healthcare sector based on regulated reimbursement rates. And those regulated reimbursement rates were cut, and the company went from being EBITDA positive to EBITDA negative. And despite the fact that that company was EBITDA negative, with no prospects to go EBITDA positive, they were holding the senior debt in that company at a mark of over 90%. Again, made no sense. And it's that as a key example, and we've seen many others like that, where we think people are taking advantage of the system by putting mark to market valuations on assets that are not realistic. And at least in my opinion, that's a place where regulators could come in to make sure that information that is being given out to investors is more accurate, and work can be done on getting to some type of regulatory framework that would mitigate the excesses in that department.
Yeah, I think you've got plenty of company in that hope. We will see if that comes to bear at some point. But we'll leave it there on that bit of a cautionary note. But once again, Stuart, thank you very much for your time. Super insightful, and that differentiation between what's going on in the larger part of the market versus the middle market and lower, I think, is a really important distinction. And thank you for shedding a lot of insight on that today. Thanks for your time.
Thank you for your time, Dan. I appreciate it. Have a great day.
You too. Thanks for listening to our latest Leading Voices in Credit podcast. Make sure you tune in for a new episode, and don't forget to tune in weekly for our 3 Things in Credit podcast. Happy listening.